Ever pondered why your investments aren't yielding the returns you anticipated? It's a question that keeps many of us up at night, isn't it? Well, it could be because of poor investing habits. Watch this video to the end so as not to miss any important details from Dr. Samuel Adebayo. If you are joining for the first time, like and share this video. Let's delve into this intriguing world of finance together. Investing, a term that evokes mixed emotions, is often misunderstood. It's a world that can be as thrilling as it is intimidating, a journey filled with opportunities and potential pitfalls. Some see it as a gamble, a game of luck, where fortunes are won or lost on the turn of a market trend. Others view it as a science, a complex algorithm of factors and variables that only the most brilliant minds can master. But let's debunk these misconceptions. Investing is neither a game of chance nor an inscrutable science. It's a practice rooted in discipline, research, and strategic decision-making. It's about understanding the value of assets, recognizing market trends, and making informed decisions based on those insights. Yes, there's risk involved, but there's also opportunity. The key lies in managing the former while seizing the latter. The challenge is not in investing, but in making smart and educated investment decisions. The struggle is real, especially when it comes to investing. We've all had those moments, right? Those sleepless nights where we ponder over our investment decisions, wondering whether we made the right choice. Should we have bought or sold? Should we have invested in this or that? These questions often haunt us, and the reason is simple. Investing is not a walk in the park. One of the primary reasons people struggle with investing is a lack of knowledge. It's like trying to navigate a maze in the dark. Without proper understanding of financial concepts, market dynamics, and investment tools, it's easy to lose your way. You might find yourself investing in assets that are not suitable for your financial goals or risk tolerance. And when the market takes a downturn, you're left wondering where it all went wrong. Then there's the trap of emotional decision-making. Investing, like any other aspect of life, can stir up a whirlwind of emotions. Fear, greed, hope, regret. These are all emotions that can cloud our judgment and make us take impulsive decisions. You might sell a stock out of fear just before it bounces back, or buy a stock out of greed just before it crashes. Emotional investing often leads to buying high and selling low, exactly the opposite of what you want to do. And lastly, there's the pitfall of following trends without understanding. It's easy to get swept up in the latest hot trend. Everyone seems to be making money from it, so why shouldn't you? But here's the catch. Investing is not about following the herd. It's about understanding the value of an asset, assessing its potential, and making informed decisions. Just because something is trending doesn't mean it's a good investment. Remember the dot-com bubble or the housing market crash? Those who followed the trends without understanding found themselves in hot water. The good news is, these challenges are not insurmountable. With the right knowledge, discipline, and approach, you can turn the tide in your favor. The key is to learn, adapt, and grow. And that's exactly what we'll be discussing in the next part of this video. Investing is not about getting rich quick. It's about growing wealth over time. It's a mantra that every investor, novice, or seasoned needs to remember. One of the key pillars to successful investing is research. Knowledge, as they say, is power. The more you know about a company, its industry, its competitors, and the overall economic environment, the better equipped you are to make smart decisions. It's not just about reading financial reports or crunching numbers. It's also about understanding the trends that drive a company's growth and the risks that could hamper it. Now, you might wonder, what if I don't have the time or expertise to do all this research. That's where diversification comes into play. By spreading your investments across different asset classes, sectors, and geographical regions, you can mitigate the risks associated with a single investment. Think of it as not putting all your eggs in one basket. Diversification doesn't guarantee profits or protect against losses, but it does offer a level of protection against the unpredictable nature of markets. Long-term planning is another crucial aspect of investing. The market is a roller coaster with its ups and downs. If you're constantly worried about short-term volatility, you'll end up making impulsive decisions that could hurt your portfolio. Instead, focus on your long-term financial goals. Whether it's retiring comfortably, buying a house, or funding your child's education, having a clear objective can guide your investment decisions and keep you grounded during market fluctuations. Now, let's address some common mistakes. Trying to time the market, for instance, is a futile exercise. Even the most experienced investors can't predict market movements with absolute certainty. Instead of trying to buy low and sell high, a more pragmatic approach is to invest regularly, regardless of market conditions. This strategy, known as dollar cost averaging, can lower the average cost of your investments over time. Chasing hot stocks is another pitfall to avoid. It's easy to get swept up in the hype surrounding a high-flying stock. But remember, past performance is not indicative of future results. Just because a stock has been doing well doesn't mean it will continue to do so. Instead of chasing trends, focus on companies with solid fundamentals and a proven track record of performance. In the end, it's about being disciplined and patient. The stock market is not a get-rich-quick scheme. It's a platform for wealth creation, where the tortoise often beats the hare. So, take your time, do your homework, and stick to your plan. Remember, success in investing comes from making informed decisions, not impulsive ones. So, the next time you're tempted to jump on the latest investment bandwagon, take a step back and ask yourself, is this in line with my long-term financial goals? If the answer is no, it's probably best to steer clear. After all, the goal of investing is not just to make money, but to preserve and grow your wealth over time. It's time to change gears and reevaluate your investing approach. You may have been treading the same path, hoping for different results, but sometimes the only way to see change is to initiate it. Consider this as your eureka moment, the turning point where you step back, reassess your investment strategy, and realize that there's a need for change. It's like waking up from a long sleep, seeing things in a new light, understanding that what worked yesterday might not work today. In the world of investing, it's not survival of the fittest, but survival of the most adaptable. The financial markets are not static. They are dynamic, evolving entities that require investors to be equally adaptable. Perhaps you've been chasing the market, trying to time your investments perfectly. But the reality is, even the most seasoned investors find it difficult to consistently predict market movements. Instead, focus on what you can control: your investment strategy, your asset allocation, your risk tolerance. Maybe you've been swayed by the allure of trending stocks, trying to ride the wave of their success. But remember, what goes up must come down. It's important to diversify, to spread your investments across various asset classes, to mitigate risk and increase potential returns. And let's not forget the impulsive decisions, the ones made in the heat of the moment, driven by fear or greed. These are the decisions that often lead to regret. Investing is not a game of chance. It's a game of patience and discipline. So, take a moment. Reflect on your investment journey so far. What have been your successes, your failures? What lessons can you learn from them? How can you apply these lessons to your future investments? Remember, the goal is not to make a quick buck, but to build sustainable wealth over time. It's not about hitting the jackpot. It's about consistent, measured growth. Investing should be a journey, not a destination, and every journey needs a good roadmap. So, what have we learned today? We've delved deep into the world of investing and debunked the myth that it's a simple game of chance. We've seen that the real key to successful investing isn't about chasing hot trends or trying to time the market. It's about education, discipline, and patience. It's about understanding the market, conducting thorough research, and making informed decisions. It's about diversifying your portfolio to spread risk and planning for the long term rather than seeking quick wins. It's about resisting the lure of emotional decision making and standing firm in the face of market fluctuations. We've learned that the path to successful investing can be a challenging one, fraught with pitfalls for the unprepared. But with the right approach, armed with knowledge, and guided by discipline, this journey can lead to fruitful rewards. Investing is not a game of chance, it's a game of skill. And like any skill, it can be improved with practice, patience, and persistence. Now that you have a better understanding of investing, keep the momentum going. Subscribe for more invaluable insights, and don't hesitate to share your personal investing journey in the comments section. Remember, the road to financial freedom starts with a single step. Take that step today.